Carried interest is one of the biggest ways that real estate investors get paid, but the way this is calculated can get pretty complex. Between preferred returns, additional hurdle rates, and even the terminology that's used in these partnerships, there's a lot to know about this subject, and these structures can also vary a lot between different deals. So in this video, we'll break down what carried interest really is in commercial real estate, how this tends to be calculated by investors, and why this matters for you if you're involved with this industry. So to start by defining what carried interest is, this is essentially a share of the cash flows generated by a property allocated directly to the general partner or GP in a deal or fund beyond what their share of cash flows would have been based solely on their equity contribution. And in commercial real estate specifically, this is typically referred to as promoted interest, or the promote for short, and this is intended to be a performance-based incentive for exceeding investor return expectations. And to illustrate this with a really simple example here, if a GP invested 10% of the equity required in a deal and the LP invested the remaining 90% of the equity required with a 20% promote structure, once a specified return hurdle is hit, the GP would be distributed 20% of the cash flows on top of the cash flows they would have otherwise received based on their initial equity contribution. Now, when it comes to return hurdles, what you'll hear most often referred to when talking about these structures is the preferred return, or the pref, and this is the first return hurdle the limited partners on a deal need to hit before promoted interest is earned. Now, the preferred return can be based on several different return metrics, and while the IRR tends to be the most common metric used, especially among institutions, the equity multiple and the cash-on-cash return are also sometimes considered. You also might see multiple different preferred return hurdles on the same exact deal, so something like an IRR and equity multiple based hurdle requirement, or something like a cash-on-cash based hurdle during ordinary operations and an IRR based hurdle when the property is sold. Now, what these preferred return amounts are can vary a lot based on the risk profile of a deal and the negotiating leverage of the GP, but in general terms, IRR-based preferred returns will usually fall somewhere between about 7% and 9% on these deals. Equity multiple-based preferred returns will usually fall somewhere between about 1.5x and 2.5x, and cash-on-cash-based preferred returns will usually fall somewhere between about 6% and 8% per year. Now, up to the point when that preferred return is hit, the GP and the LP on the deal will usually split cash flows in proportion to the equity each partner contributed upfront. So in the example I used earlier, where the GP invested 10% of the equity and the LP invested 90% of the equity, the GP would usually be distributed 10% of all cash flows up to the preferred return, and the LP would be distributed the remaining 90% of the cash flows until that pref is hit. But once that preferred return is exceeded, this is when promoted interest starts to come into play, with each investor's initial equity contribution also typically being factored into the mix. And to calculate cash flow distributions at this point, to go back to the example we used earlier, with a 10% equity contribution from the GP, a 90% equity contribution from the LP, and 20% promoted interest above that preferred return, once that preferred return is exceeded, the GP would be distributed 20% of all cash flows above this, plus their original 10% share of the remaining 80% of the cash flows, for a total of 28% of distributions above the preferred return. Now, another thing to keep in mind here is that many JV equity partnership structures will also have additional return hurdles beyond just the pref, with even higher promoted interest percentages once those hurdles are hit. So while you might see a 20% promoted interest structure on all cash flows above something like an 8% IRR, for example, that same deal also might call for a 30% promoted interest on all cash flows above an 11% IRR to the LP, which provides even more of an incentive for the GP to maximize returns for all investors involved. Now, another thing to note about promoted interest is that this can get even more complex with fund structures when deals perform well early on in the fund life. In some situations, promoted interest will be earned when early deals in a fund are sold at a profit before all assets in the fund are ultimately liquidated. But if market conditions change over the next few years and at the end of the fund life, the LP hasn't earned their preferred return overall, this is where something called a clawback can often come into play. And a clawback is essentially the LP requiring the GP to return the promoted interest they've earned throughout that fund life to the point that would allow them to get back to that preferred return they agreed to. Now, in most cases, when you're dealing with individual deals on a one-off basis, this isn't going to be an issue since there's only one property to be sold. But if you're working at a major private equity firm or a large institution with complex fund structures in place, this is definitely something to be aware of before getting started. Now, when it comes to how all of this ultimately affects you, there are really two main things to keep in mind about promoted interest. The first is that this tends to be one of the biggest revenue drivers for companies within this entire industry, and this is one of the main reasons why these firms are started in the first place. On a $10 million deal, for example, financed with 70% debt, a GP might only have to put in something like $100,000 to $200,000 up front with the potential to earn millions of dollars back in promoted interest alone. And this is also a huge reason why it's such a big deal to get a piece of the promote as an employee of a company, since depending on the size of the deals you're a part of, this can be a huge boost to your overall compensation. And while a high salary is great and can provide a lot of stability on a year-by-year basis, if you have the choice between an increase in salary or a share of the promote share is very likely to make you significantly wealthier over the long term. And the second thing to keep in mind here is that as an LP, this promoted interest percentage will ultimately eat into your cash flows if you're investing passively in a deal, but this isn't necessarily a bad thing in most situations. In virtually all cases, promoted interest is only earned after the LP hits their preferred return, with promote percentages only increasing after the LP hits even higher return targets, which creates a win-win scenario for all parties involved. And this is why if you're looking at two different partnership structures, one with higher promote percentages and another with higher base fees, the deal with the higher promote values will almost always better align your interests with the interests of the GP. And if you're watching this and you want to learn more about different partnership and waterfall structures used in commercial real estate, including how to model these in Excel, or you want to land a job at a major private equity firm that uses these structures and you want to pass an Excel modeling exam that might be given to you during the interview process, make sure to check out our all-in-one membership training platform, Break Into CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you'll also get access to the Break Into CRE Analyst Certification exam, which covers topics like real estate acquisition and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more content on the channel on JV partnerships or waterfall structures in commercial real estate, make sure to hit the like button and let me know. And if you're working in this industry or investing in these deals today, let me know in the comments what types of promote structures you're seeing most often. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.